Welcome to our comprehensive guide on Kenya's tax residency framework. Understanding tax residency is essential for anyone spending significant time in this beautiful country, whether for business, work, or pleasure. The rules governing tax residency in Kenya are clearly defined, and they greatly impact your tax obligations, potential deductions, and overall financial strategies. This video aims to demystify the process of establishing and maintaining tax residency in Kenya, covering vital details such as the crucial 183-day rule, required documentation, and practical tips for compliance with Kenyan tax laws. Let's dive into how tax residency is defined in Kenya under the Income Tax Act. According to this legislation, an individual qualifies as a tax resident if they meet specific criteria. Either you must have a permanent home in Kenya and spend any part of the tax year there, or you must be physically present for at least 183 days within that tax year. Additionally, showing an average presence of more than 122 days over 3 consecutive years can also establish your residency. The 183-day rule is critical, as it primarily affects expatriates and international professionals, influencing their status and responsibilities concerning taxation. The importance of the 183-day rule cannot be overstated. This threshold indicates that individuals living in Kenya most of the year benefit from the nation's infrastructure and services. When tracking your presence for tax purposes, it's vital to maintain accurate records of your entry and exit dates. Utilizing border stamps and flight records can assist in this process, and there are digital solutions available, like Pebbles, which simplify the recording of your days in Kenya, helping ensure you're not caught off guard come tax season. Being a tax resident in Kenya comes with several significant advantages, especially for those earning income within the country. One of the primary benefits is access to double taxation treaties with several nations, such as the UK and Canada, which help prevent the same income from being taxed twice. This can result in massive savings for individuals with international income sources. Moreover, tax residents often enjoy preferential tax treatment, notably lower withholding tax rates compared to their non-resident counterparts, making financial planning much more favorable for those who qualify. Lastly, let's discuss the process of obtaining a tax residency certificate in Kenya, a document that verifies your tax status and often plays a crucial role when dealing with tax treaties. The application process involves several steps, including providing essential documentation. As a tax resident, you'll be subject to taxation on your worldwide income, with Kenya's progressive tax rates ranging from 10% to 30%. Compliance is key, as tax residents must file their annual returns through the KRA's iTax portal by June 30th each year. As we wrap up this guide, remember that those navigating the complexities of multiple country residencies may require expert advice to effectively manage their tax obligations.